Dividend growth is one of the most important metrics to look at if you are a long-term dividend investor. You want a company that as it continues to increase its own earnings, it rewards shareholders along the way with increased payouts. In turn, this increases your own portfolio income without you having to add any additional capital. Your account will start to earn more and more dividends over time. And dividend growth is one of the chief factors that increases your dividend income. Often the percentage of these raises are larger and more frequent than someone may even get at their job. I don't know about you, but a growing stream of passive income does not sound bad to me. Today, I'm going to share 15 stocks that just increased their dividend payments over the past couple of weeks. And if you are subscribed to my free dividend data newsletter, then you get these dividend increases in your inbox every single week. So I've actually shared more than 40 the past 2 weeks, and today I'm going to share the top 15 most notable companies, and of course give my own brief thoughts on the stock. All right, with that said, let's dive into the dividend news. And of course, that means we need to roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock research tool available at dividenddata.com, link in the description and pinned comment. But if you want to keep track of dividend news for free, you can join our email newsletter or use the free dividend news tool available at dividenddata.com. And by the way, if you become a dividenddata.com member, you can get that news filtered by just the stocks you own or have on your watch list, plus all our other great stock research tools. But let's get to the real topic of the day. Dividend increases you need to know. This is going to come from a variety of companies. We have dividend aristocrats that have increased their dividend payments for over 25 years. We have lower yield stocks with faster dividend growth and some high yield dividend stocks that are still raising their dividends consistently. Okay, so first we have Abbott Laboratories, ticker symbol ABT. They just declared a 59-cent per share quarterly dividend, which is a 7.3% increase from the prior dividend of 55 cents per share. Abbott is a consistent dividend grower over the long term, usually increasing on an annual basis, and this 7.3% increase is following a trend of increased dividend growth over at Abbott. The 5-year CAGR is now up to 10.38%. So we have some reacceleration of growth happening. Current share price is $112.62, which gives it a 2.1% dividend yield at the current price. And the payout ratio is sustainable with a 70% free cash flow payout ratio and 62% earnings per share payout ratio. And it was actually even more sustainable in prior years. For stock number 2, we have Pfizer, ticker symbol PFE. They just declared a 43-cent per share quarterly dividend, which is a 2.4% increase from the prior dividend of 42 cents per share. Pfizer is the pharmaceutical giant, which has recently sold off a lot over the past year and a half, and a lot of that was due to a decline in their earnings and likely an overvaluation from people thinking that demand for the COVID vaccine would be much higher in the future, but that seems to have fallen off significantly. However, Pfizer is historically a long-term dividend growth stock. The 10-year compound annual growth rate of the dividend is 4.38%. This is usually a sustainable dividend, excluding fiscal 2023, which was a very weak year for the company. That year, the free cash flow payout ratio was over 192%, and the EPS payout ratio was over 436%. But that may have been an outlier because in prior years, the dividend was more in the 60 to 80% range. Notice I'm excluding 2021 and 2022 because those were massive outliers to the upside, and Pfizer will likely not be hitting that anytime in the next 5 years. But for investors focused on high yield dividend stocks, this is becoming a more interesting opportunity. The current dividend yield is 6.81%. This is the highest dividend yield in the past 10 years for Pfizer stock, which could mean this is a significant buying opportunity. However, I would suggest researching the company much more because you need to be confident that their earnings are going to rebound to stable levels. There already seems to be a slight trend back up, but you got to be sure or else this could be what you would call a value trap or a falling knife. For stock number 3, we have Broadcom, ticker symbol AVGO. They just declared a 59-cent per share quarterly dividend, which is an 11.3% increase from the prior dividend of 53 cents per share. And in the complete opposite vein of Pfizer, Broadcom stock has been taking off and just ended the day at $250 a share. The stock went up 25% and then another 11% after their Q4 earnings report last week, and I made a full stock analysis video on Broadcom giving my updated thoughts. It's 20 minutes, so if you want to watch and get my full take, go click to that video after you watch this one, of course. But in terms of the dividend, Broadcom is a dividend growth stock and has been historically. The 5-year compound annual growth rate of the dividend is 12.67%. It is sustainable based on their free cash flow payout ratio around 50%. However, because of how well the stock price has done, the dividend yield is now down to 0.94%. So in general, I think Broadcom is definitely on the pricey side and not necessarily a good value at current prices, but historically this has been a great dividend growth stock. For context, the 10-year total return for Broadcom stock is 3,226%. That is a 41.9% compound annual growth rate. Absolutely insane. But Broadcom's sky-high prices have me worried that is not set to continue in the next decade. All right, stock number 4, we have WD-40 Company, ticker symbol WDFC. They declared a 94-cent per share quarterly dividend, which is a 6.8% increase from the prior dividend of 88 cents per share. I have not really analyzed this company before, so I'll be quick with this one. The 10-year compound annual growth rate of the dividend is 9.48%. The 3-year CAGR is 6.42%, so this most recent increase is in line with that. The current dividend yield is 1.41%, and the payout ratio is 53% based on free cash flow and 67% based on EPS. And at the first glance, I do not find much attractive about this as an investment opportunity. Number 5, we have Bristol-Myers Squibb and Company, ticker symbol BMY. They just declared a 62-cent per share quarterly dividend, which is a 3.3% increase from the prior dividend of 60 cents per share. And this is another drug company which has sold off as of late, and that has increased the current dividend yield to 4.4%. 10-year CAGR of the BMY dividend is 5.3%, so this most recent increase signals a slowdown. However, it is very sustainable based on free cash flow and net income, 37.5% free cash flow payout ratio and 59% EPS payout ratio. Stock number 6, we have Nucor, ticker symbol NUE. They just declared a 55-cent per share quarterly dividend, which is a 1.9% increase from the prior dividend of 54 cents. Nucor is a steel company with a long history of dividend growth, although that growth was extremely slow for much of the past decade until you got to 2021 and we got in that inflationary cycle and steel prices went nuts, and you can see Nucor's earnings just boomed in that time, but since then they have come all the way back down. I've made videos about Nucor stock in the past, and it was definitely a good trade. I sold mine at a pretty good gain from 2020 to 2021, but then I wanted nothing to do with this stock because I knew that high of earnings was not going to last. That said, the Nucor dividend is a sustainable payment. Current yield is 1.77%. The payout ratio is very low, but that is using recent numbers of earnings and free cash flow, and that seems to be trending down in the coming and future years. Using 2023's free cash flow per share of $19.61, which again is very high. Free cash flow payout ratio is 10.5%. EPS payout ratio in fiscal 2023 was 11.37%. And if we look at how fiscal 2024 in the first 3 quarters is going for free cash flow per share, they will be lucky if they can get over $7 a share. You can see they had negative 87 cents, $2.86, and $2.02. So they'll be lucky if they can repeat Q4 2023. Okay, stock number 7 is Mondelez, ticker symbol MDLZ. They just declared a 47-cent per share quarterly dividend, which is a 10.6% increase from the prior dividend of 42 cents. This is a pretty famous chocolate company, which just recently was rumored to acquire Hershey's, but it seemed like that fell through completely. And I'm okay with that because I'm more interested in Hershey as a stock and think they have better brands in my opinion. But still, since 2012, the company has been on a dividend growth streak. And this is actually pretty great growth. 5-year CAGR of 10.52%. And they've been hitting 10% every year like clockwork recently. The forward-looking annual dividend payment is $1.88, which gives it a 3.06% dividend yield. Payout ratio is 59.97% and EPS payout ratio is 43.56%. So this may be an interesting one to look at if you're looking for that good combination of starting dividend yield with dividend growth. 3 plus 10, not bad. All right, for stock number 8, we have Amgen, ticker symbol AMGN. They just declared a $2.38 per share quarterly dividend, which is a 5.8% increase from the prior dividend of $2.25 per share. And this is another healthcare drug company which is doing pretty well. You can see earnings per share have just steadily climbed over the past few decades, and the most recent quarter was all-time highs and signaling that there may be strong growth ahead. But what's interesting is the stock did sell off from that point as well. So that boosted the current dividend yield to 3.57%. So another pretty strong yielding stock here. And historically, this is a dividend growth stock. The 10-year compound annual growth rate of the dividend is 11.66%. However, this is slowing down. The 3-year CAGR is 7.05%. And the most recent increase was 5.78%. And the payout ratio has been growing, meaning that dividend increases have exceeded their increases in free cash flow and net income. Free cash flow payout ratio is up to 61%, which is sustainable, but notice this trend of increasing over time. And the net income payout ratio is 67.83%. And I have never done a full analysis on Amgen, so I'm not entirely sure about all the intricacies of their business. But you can see that over the past 5 years, free cash flow per share has been flatlined and even declined. But if somehow they can return to this 2012 through 2018 era of growth, then this may be a great entry point at a 3.57% dividend yield. But I don't know if that's going to happen. For stock number 9, we have Realty Income, ticker symbol O. They just declared a $0.264 per share monthly dividend, which is a 0.2% increase from the prior dividend of 0.264. And yes, you heard me right, monthly dividend. Realty Income is known as the monthly dividend company. And they have a very long history of dividend increases, often multiple throughout the year. The 10-year compound annual growth rate of Realty Income's dividend is 4.06%. The 3-year CAGR is 2.31%, so growth is slowing down. But that said, it is a high-yielding stock at a 5.8% dividend yield. And based on free cash flow, Realty Income is a very sustainable dividend payer at 71%. It's important to remember that this is a real estate investment trust, and the stock has fallen recently, so this makes the current dividend yield one of the highest in the past decade, excluding a lot of the last year where it was also kind of a high dividend yielding stock. And of course, March 2020, when all of the real estate stocks just crashed insane amounts. Stock number 10, you have Morningstar, ticker symbol MORN, declared a $0.455 per share quarterly dividend, which is a 12.3% increase from the prior dividend of $0.405 per share. This is a pretty interesting company which saw a big dip in earnings during fiscal 2023, and the stock price followed suit. But they have since rebounded and are back up to all-time highs on both stock price and earnings. The 10-year compound annual growth rate of the dividend is 9.13%. The most recent increase was 12.35%. So we have a re-acceleration in dividend growth going from 4 to 8 to 12. However, the stock price is at all-time highs. The dividend yield is now 0.51%. And the payout ratio is low and sustainable, but not super low for a 0.5% dividend yield. Free cash flow payout ratio is 32.39% and 45% based on net income. To be fair, that was using fiscal 2023, and they're about to blow that out of the water in fiscal 2024. So that payout ratio number is going to go down significantly. So that kind of brings up a very important detail when looking at payout ratios. That is always a trailing number. So for example, this next fiscal year for Morningstar is almost over. So you can already go and look at the first 3 quarters of the year and see that they've already exceeded $6 in free cash flow per share, which significantly beat the $4.60 from last year. There's actually a chance they may hit all-time highs in free cash flow per share, eclipsing fiscal 2021. Okay, for stock number 11, I'm going to pick Ecolab, ticker symbol ECL, which is a dividend aristocrat. They just declared a 65-cent per share quarterly dividend, which is a 14% increase from the prior dividend of 57 cents. This is a lower yielding dividend aristocrat, though, at 1.05%. And if we look at their dividend, you can see that they do have a trend of increasing growth in recent years. They've gone from 3.92 to 7.55 to 14% in the latest increase. I'm not sure if that increased growth will continue moving forward. The 10-year compound annual growth rate of the dividend is 7.01%. The payout ratio is very sustainable, though, at a 37.71% free cash flow payout ratio and a 44% EPS payout ratio. For stock number 12, we have the Walt Disney Company, ticker symbol DIS. They just declared a cash dividend of $1 per share, which will be paid in 2 installments of 50 cents per share annually. And when you compare that to the annual dividends they paid last year, that is a 30% overall increase. And this next payment coming in January will be the third dividend since Disney started paying dividends again. They suspended their dividend in 2019 after the pandemic closed down the movie theaters and their parks business, and they did the very costly transition to streaming services. However, now the company is profitable again and growing their dividend. If we look at Disney's free cash flow per share, you can see that in Q4, they nearly hit their all-time high in free cash flow. And they also just gave 3 years of forward-looking guidance, expecting greater than 10% growth in earnings each of those years. And that caused analysts to increase their estimates as well, and gave a pretty big boost to their stock price after their recent earnings report, which was badly needed because this stock was beaten down rough. This is still a low-yield dividend stock, though, at a 0.89% dividend yield. It's a semi-annual payer, but it has a very low payout ratio at 15% based on free cash flow and 27% based on net income. So if you own Disney stock, I would expect continued dividend growth in the coming years. Stock number 13 is Deere, ticker symbol DE. They just declared a $1.62 per share quarterly dividend, which is a 10.2% increase from the prior dividend of $1.47. This is John Deere, one of the best known brands in construction and farming equipment. The company has been a dividend growth machine, especially over the past 5 years. It is inconsistent, though, in its frequency of growth. From 2014 all the way to 2020, they only had 2 dividend increases in that time. But then they went nuts with it and basically increased it like every other payment for the span of 2 years. So that boosted the 5-year compound annual growth rate of the dividend to 16.34%. The current dividend yield is 1.48%. And this is a very sustainable dividend payment too, at a 21% free cash flow payout ratio and 22% EPS payout ratio. So as long as the company can grow long term, which there's been some short-term questions about, then you should expect dividend growth to continue for Deere. All right, for stock number 14, we have Enbridge, ticker symbol ENB. This is a Canadian stock, so it is in CAD, Canadian dollars. They just declared a 0.9425 Canadian dollar per share quarterly dividend, which is a 3% increase from the prior dividend of, I'm not going to say that again. Now, this is actually a pretty high yielding stock with a current yield of 6.45%. This is actually one of the more popular dividend stocks in the oil and gas pipeline space. 10-year compound annual growth rate of the dividend is 6.19%. The current payout ratio based on free cash flow is 81%, but historically, this is a company where it gets a little iffy on the payout ratio metric. And if we take a look at the balance sheet, this is a company with a lot of debt, $93.4 billion net debt. However, to be fair, their free cash flow is improving. You can see that they rarely have losses anymore and consistent free cash flow. And fiscal 2023 was an all-time high, but that's on pace to be lower in fiscal 2024. All right, finally, stock number 15, we have Aflac, ticker symbol AFL. They just declared a 58-cent per share quarterly dividend, which is a 16% increase from the prior dividend of 50 cents per share. And this is a stock where I'm always surprised when I take a look at how well it's doing. You can see that earnings per share are reaching all-time highs. But if we take a look at free cash flow per share, that has actually been declining. But Aflac does make a lot of money, and they pile that into dividend growth and very large amounts of share repurchases. This is a company where they've been buying back 5 to 6% of their shares outstanding a year. The dividend is growing at an 11.52% 10-year compound annual growth rate. This has accelerated to a 3-year CAGR of 13.19%, and the 2 most recent increases were 19% and 16%. And with how well the stock price has been doing lately, the current dividend yield is still 2.23%. And on top of that, the payout ratio of the dividend is still pretty low. The free cash flow payout ratio is 30%, and that's despite the declines in free cash flow per share. The net income payout ratio is 20%, and based on GAAP accounting net income, Aflac is not seeing this trend of increasing payout ratio. This may have something to do with how insurance businesses do their accounting. I might have to look more into that. But Aflac is definitely a very interesting dividend growth stock to have on your radar. All right, so those are 15 dividend increases that you should know about. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And again, if you join our free newsletter, you can get breaking dividend news. Plus, you can use our free dividend news tool or upgrade and get the full suite of features over at dividenddata.com. That includes dividend news filtered by the stocks you own and have on your watch list, plus a great stock analysis tool and our new AI analyst where you can ask practically any question you want about a stock. Go watch my full breakdown video if you want a tutorial on that. But thanks for watching, and I'll see you in the next video.